ratios. And what are the kind of key financial ratios that we should know when we are looking for companies. So as you can see here, let me show two instances. So you can see here, as soon as we go into Screener, we get something like this: market cap, current price, high, low, dividend yield, book value, ROE, ROC, etc. But when I logged in, this is my login ID, you can see there are a lot of other numbers over here that are not actually present over here. So what are these other numbers? Why am I using them? What is the benefit of these other numbers? We'll be sort of talking in general about financial ratios and what it tells us about the health of company. Right. And we'll talk about some other things, including like promoter holding is not a financial ratio, but we'll be talking about things like this as well. Right. And then we can create our own ratios on Screener. Like, for example, and we can create our own ratios on Screener. Like if we see over here, you see this create new ratio. So these are some ratios that I have created that are typically not that may typically not be used, right? And we can create any other new ratio that we want. Any sort of ratio that gives us a better information of what the company does. So what we'll do is we'll start looking at some standard ratios and understand what they are. And then as we get more comfortable, we will be able to create our own ratios based on our own approach to investing. Like I have created a few ratios of my own, and in the same way, we can create anything that we want, right? So now we know the three fundamental financial statements. So the first thing that we are looking at is, okay, now what company do I invest in and what should I typically not invest in, right? And we'll be looking at some of the ratios. So this is just a generic list in terms of what are generally used, and we'll start. So liquidity ratios, right? It is the ability of a company to repay its short-term debts. So how can the company, is the company liquid enough in order to repay its debt? Because if a company cannot repay debt, then the company will sink. That's what happened to some of the, some of the major, some so-called major companies that were existing in this country, and then their promoters and all ran away to London and to all these other places, right? Because their company sank. So even if you look at Vijay Mallya, for example, former member. Okay, so what has he said? He says that we have actually, Indian government has taken double the debt, right? So he was owing some debt, and then he's saying now he has, and then he ran away to a different country, and there were court cases and whatnot. And then he's saying he's run away with the money and so on, and he's not able to repay his debt and all. Now he says I've paid double the debt. So the main thing one of the first things that we look at any company is company should be financially liquid, right? It should be able to meet its debts, and it should not be able to, it should not sink. So the typical things we look at is debt to profit, debt to equity, right? And current ratio. These are the things I have. There is also a quick ratio, one more ratio called quick ratio. We can't look at all of them, but what I look at is the current ratio. Typically these three ratios. Now, what is debt to profit? So debt is obviously the total amount of debt owed, right? So let's say, for example, let's take a simple example for debt to profit. Let's say I take a loan of 10 lakhs, okay? And my annual income, let's say, is also 10 lakhs, but I spend, say, about 5 lakhs on my day-to-day expense. And after after everything, I have 5 lakhs left, right? So my profit after tax, after my income, after everything is, I have 5 lakhs of money left. Okay. So in this case, I have to repay a debt of 10 lakhs and every year I'm able to save 5 lakhs after all my different expenses. So how long will I take? I will typically take 2 years to repay this if I put all my money back into paying the debt. Now let's take another case. Let's say that I am spending as much as I am earning and I'm not able to save much. So I'm only able to save 1 lakh in this case. Okay. So if I'm only able to save 1 lakh a year, then it will take me 10 years. Assuming I put this extra amount fully into the debt, it will take me 10 years. But let's say on the other hand that the person is earning a lot and the person is able to save more than 1 crore, right? So in this case, this debt of 10 lakh is nothing. The person will be able to pay it like within a couple of months, within 1.5 months. So then when we look at the debt to profit, one of the things we are looking at is how quickly, if the company is earning a certain amount of profit, then how quickly can the company repay its debt? So the lower this number, typically the better. We don't want a company with an excessively high debt. This company, for example, Canterbury will take 6 years at its current level of profit to repay the debt. Of course, if the profit keeps increasing year on year and the company is expanding, then as the profits keep increasing, it has a better capacity. But as of now, this is the number. The second number we are looking at is what is debt to equity. So this is nothing but debt by shareholders' equity. Debt by shareholders' equity. Right. So this is one more measure which is telling us that in financial terms, right, the shareholders have a certain amount of equity and this company has more debt than the shareholders' equity, which is not a great thing, right? This number, if it is more than 1, it means that the company has taken an extra amount of, means it's taken somewhat higher debt and maybe more prone to risk. So let's come over here to the watch list view. And here I have, you can see over here, we have debt to equity. And we can like screen it on an ascending or descending manner. So we'll just look at debt to profit as well for the sake of discussion. We'll start with debt to profit. Debt to. Okay, let's look at this debt to profit. Okay. So as we can see here, these companies, CDSL, eMudra, Clean Science, all these companies here have a very small debt as compared to their profits, right? All these companies here, which means from a debt perspective, they are very, very safe. Even if you buy the company and the company, let's say for a couple of years, it doesn't make great profit, it makes some losses, or the profitability is not great, etc. It faces some challenges. There is no problem because we know that the company will not sink. But as we go down, we can see debt to profit is increasing. And at this point, Mrs. Bector's Food has a debt that is slightly higher than the yearly profit, right? And then we can see over here, as we come down, there are companies which have a very high amount of debt. Hindustan Foods, for example, Canterbury Retail, which we saw, Go Fashion. So there are companies which have like very high amounts of debt. Now let's just go to this. We'll see one more thing. Screener, create new screen. Debt to profit is greater than 100. Let's see how many companies are here. Are there any? Yes, there are actually 120 companies which have a very high debt to profit, right? So these companies are all risky companies. Based on this number itself, I would say, no, don't go near these companies. These companies may have a huge risk. And do we see any good company, any name that we know of? Typically, we may not, right? So now the next measure we were seeing was debt to equity. Let's come here. So again, debt to equity, we see that certain companies we see here, the same companies which had a low debt to profit that we saw last time, some of the same companies have a very low debt to equity as well, right? And typically all these companies that we see which have a low debt to equity, these are all very safe to own. Like we know that even if something goes wrong for a few years, nothing much to be risked. Whereas when we go down over here, we see these companies, Hindustan Foods, Cantabile Retail, etc., they have relatively more high debt to equity. So tomorrow, let's say something wrong happens in their business, for some reason they are not able to make a profit, etc., then they may go under, they may not be able to repay their debt. So for example, let's say that a person is building a hotel, okay? They are building a hotel and they took a huge amount of debt. They completed this hotel in 2019. Okay, now they are expecting that, okay, now this hotel is live and it's in a prime location. I'm expecting people to repay the amount. I'm expecting people to come use the hotel. I'm expecting some profits, etc. And I will be able to repay that debt. That's what the owner is expecting. But what happens in 2020? We have COVID, right? And if we actually saw during COVID, many restaurants, many hotels and all went under. Like many of them sank because they were not getting any business, and if any of them had any debt, then they are not able to repay their debt, and that's a huge problem. So this is the next thing that we typically see: debt to equity and debt to profit. Then the other thing, this is not so important, I don't look at it so seriously, but it is something we should know. It is current ratio. So in the balance sheet, if we remember, we have seen current assets and current liabilities. So the current ratio is nothing but current assets by current liabilities. And then if the current ratio is high, it means that the current assets are greater than the current liabilities, right? So it means if there are any immediate repayments that need to be done, the company can easily do it. So eMudra, for example, this has a low debt to equity. This has a low debt to profit. And then you can see its current ratio is quite high. So this means that from a debt perspective, this company is very, very safe. We don't have anything to worry about. Okay. We will not go into quick ratio and all. Yeah, current assets by current liabilities, that is current ratio. And current ratio. So let's look at, let's again go to screener, create new screen. Okay. So when I say current ratio is less than 3.5, then you can see there are 390 companies. So this means that these companies have very less current assets as compared to their current liabilities. So let us try to arrange this. And you can see all these set of companies have very, very low current ratios. They have some negative current ratio, which means they don't have any assets at all. Or I'm not sure, something may be wrong, but typically you see all these companies have very low uh, current ratio. And you can see if we look at these names, these are all names that are not among the great companies typically when we look for these ratio, when we look at these numbers. So that is the next measure that we need to know of, which is the three things: the debt to equity, debt to profit, and then the current ratio. So these three together give us a picture of a company's debt position. So let's look at, for example, Cantabile Retail, and we can see here debt to profit is a little on the higher side. Debt to equity is also a little on the higher side, but current ratio is fine. They'll be able to manage it, right? So this gives you a picture. And then along with their sales growth. So right now we are seeing that the debt to profit is actually a little on the higher side. But if their sales is growing fast, then we know we don't have anything to worry. So if we look at their average sales growth over here, it's more 20%, 30%, 80%, and so on. So it means that they are getting more and more profits every year. So they are taking more debt, they are expanding, and they expect to repay the debt. That's what this picture looks like. So but then again, the risk is that if for some reason this company is not able to sell for some reason for a few years, then it will have trouble repaying this debt. So it's a risk the company has chosen to take, believing that the company will expand fast and it will continue to expand fast. As we can see over here from its profit growth, and then we can see over here from its uh, balance sheet, we can see fixed assets. Fixed assets, which was 14 crore, is growing, 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 and it's now more than 30 times of what it was 10 years back. So this company is expanding very, very fast. It's been taking some debt and its profits are growing very fast. That is the story of this company. If this company can continue doing this, then no problem. We don't have to worry about this debt position. It will continue to repay the debt, continue to grow. But if the company has some problem and it's not able to make sales for say a few years, then the company will have problem repaying the debt. So that is what the debt related aspects tell us. Right. Then next thing is profitability. So we were looking at the profit margins. And we have over here the operating profit margin. And then we have over here the net profit. Right. So the profit margin gives us the percentage. This is nothing but profit to sales. Operating profit margin gives us the operating profit to the sales. Net profit margin gives us this number to the sales. So typically, what are we looking at? We are looking at companies which have higher profit margins. They are better to own. So do I have profit margin here? Let's see. Yeah, we have net profit margin of the previous year, annual, right? So we see here a company like Dixon Technology. So what does Dixon Technology do? It does contract manufacturing for electronic goods. Like, for example, your mobile phones, if say Nokia, Samsung, someone wants mobile phones, they will outsource it to Dixon. Dixon will do the manufacturing for them according to their standards and all that. TV and electronic goods. And Dixon, you can see here, makes a wafer thin margin, right? Now, let's say some cost of some raw material or cost of anything goes up, then this profit margin is threatened very quickly. Whereas if we come down over here, we look at a company like CDSL, the company. So all our shares typically are either one of the depositories. CDSL is one of the depositories, so the largest depository in India. So most of our shares and all are stored in CDSL. So you can see here the profit is 50%. Even if something goes wrong, right? The profit may come down to 40%, it may come down to 30%, but the company will not go into losses. So typically, the more the net profit margin, the better the health of the company. So we typically will look at the operating profit margin because here depreciation and all of that, they can manipulate some of these numbers. They may choose to pay a certain amount of interest. They may pay a very high interest. They may choose to pay a certain high amount on a certain year. They may choose to pay a slightly lower amount during another year and so on. And therefore, they can basically manage the net profit number. But operating profit is not so easy for them to change. So that is why typically, if you see over here, we have operating profit margins that are being shown, and then we can also look at net profit margin to get a sense of how the company is doing. Now, one of the things that we need to keep in mind when we look at this profit margins is the relationship of profit margin to share price. So cyclical companies typically go through cycles, right? And we see over here, operating profit margin of this company, Relaxo Footwear, is 11% here. And then from 11%, it's gone higher. It's gone to 21%. And now it's again gone down to 16, 12, 14. It's at about 14%. So let's look at the share price of this company over the last 10 years. So you can see around 2021, this was at its peak. It was quite low. And then it went higher, went to its peak. And then it started coming down. Right. So as the operating profit margin went up, this company's net profit also started going higher. And then as the operating profit margin, as you can see here, this has come down a bit. The net profit also has come down somewhat. And then the stock price also has come down. So this typically gives us the operating profit margin gives us a sense. You don't even have to look at the share price. Just by looking at this number, we'll be able to predict that around up to 2021, the stock price went up, and then after that, it would have been coming down, right? And cyclical companies typically have profit margins that go between a certain a low number and a high number, and then keeps fluctuating between them. So let's look at CDSL, for example. Yeah, so we can see here The operating profit margin was around 35%. It went up on average, and it's been at about 66%. And then it's come slightly down now to about 60%. So when the company's operating profit margin is very high, then the share price would have been up. As the operating margin comes down, the share price goes down, and especially for companies which depend on raw materials. So for example, if a company depends on oil and oil prices fluctuate, the operating profit margin of the company may also fluctuate accordingly. So we see Asian Paints over here from about 16%. It went to about 21, 22%, and then it's again been coming down a bit. Right. So companies may typically fluctuate along their operating profit margins. We need to understand. We look at the last, say, several years, we see what is the highest, what is the lowest. If the company is at or near its lowest, then we see why has it gone low, right? And then if we think that no, this is a temporary phase and this operating margin will come back up, this operating profit margin will come back up over the next 3, 4, 5 years, then it's actually a good time to purchase the company. Okay, so we've looked at the two profit margins. Then we are going to look at return on equity, return on capital, etc. So I think without getting into the specifics of it, one of the key things that we need to see is, so I own a company, okay? I have 100 crores of ownership over a given company. Then what is the returns that I'm getting on that 100 crores? So am I getting 10 crore, 20 crore, 30 crore, right? So return on equity will calculate, given that there's a certain equity, there's certain money has gone into a company, then what is the returns that they are able to generate? So this is the return on equity, and this number typically above 15% is a good number. So if we go to our screener, our screen, right, and let me say, I will create a new screen saying return on equity is greater than 30. Let's just say we give this screen. Here is ROE. Okay. So some companies have a very high number, but typically we'll see that all the good companies, or let's do it this way. Let's look at the good companies that have been in this, that are well-known marquee companies in India. We see HUL has a return of equity of 20. Let's go to Procter & Gamble. Procter & Gamble has an ROE of over 30. Titan has an ROE of over 30. TCS has an ROE of over 50. Right. So companies that are like the well-known branded, the marquee companies in India typically have a good ROE of at least above 15, 20 typically. What that means that they are, given that the shareholders own a certain amount, the company is able to generate good amounts on that ROE, on that equity. So that means the company is able to make money today, but we don't know how much the company will expand tomorrow, right? But this having a good ROE is a good sign for any given business. Okay. Then we look at ROCE, return on capital employed. So return on equity only looks at the shareholders' equity, right? But it does not take into account debt. So there may be cases where I've taken a huge debt, I have a small equity, and then because I've taken a huge debt, I'm able to build all those machines and everything, and I'm able to generate more money. But in that case, my ROE will appear to be very high. But that doesn't necessarily mean that I'm running a very safe business. So then there we also look at the return on capital employed, and this gives us the return on the total capital that is employed, right? So what is the capital employed? Let's look over here. So it is the total capital employed for the acquisition of profits. Okay. So it is basically total assets minus current liabilities. That is how they look at the capital employed. Or yeah, total assets minus current liabilities. So what are all my assets minus the payments and the little things I need to do for now in the next 2, 3 months. That gives a sense of my total asset of my capital employed. So here the return on capital employed also takes into account the debt. So if a company has a huge amount of debt and the assets are very, very huge, but the company is not generating a good amount of money, then this value may be somewhat depressed, right? So typically at a starting level, we should look at these two numbers. And then the third number that we can look at is return on assets. So return on assets is nothing but the total assets that are employed. We are not minusing any current liabilities. We are just looking at the total assets. So if let's say company one has a certain set of factories and let's just say the company has factories, it's manufacturing and it's selling. Let's just take into account factories and machinery. Then we'll see what is the kind of return the company is generating. So let's take a simple example. Let me change this and I will add. Okay, we have return on assets over here. Yeah, so we have return on assets. And here we can see, okay, given that a company has a certain asset, how much is the amount that the company is generating? And typically the higher the ROE, on average, the better. We expect typically the higher the ROA, the return on assets, the better, right? So for all these three numbers, we look at how high it is. As a starting point, we can just look at these two numbers. And if it's above, say, 15%, we are okay as a starting point. 20% is good, is pretty good. So we can just look at, for example, let's look at two companies, very similar companies, Asian Paints and Berger Paints. Okay, so here they are both in the same sector. So based on what we've learned, we first looked at the debt. So what is Asian Paints debt to profit? It is 0.45. So if it earns say 100 crores of profit a year, then it has taken around 0.4, about 45 crores of debt, right? Debt to equity is 0.14. What about Berger Paints? We see here debt to profit is a little higher. Debt to equity is pretty similar. Current ratio, this is 1.83. This is 1.80, very similar. Now, what is ROE and ROCE? This is 37.5, 31.4. Here we can see ROCE and ROE are a little lower for Berger Paints. But again, these are also very good numbers. Then we were looking at the profit margins. So we see over here that Berger Paints has a profit margin of about 12% over here. And then it is coming up. It is going to 17%. And now it's gone slightly down to 16%. Asian Paints we see is at about 16% is the bottom, and it's basically gone to about 22%, and now it's come to 19%. So then, as we can see over here, Asian Paints typically has a slightly better operating profit margin as compared to Berger Paints, right? Then what is the next thing we see? Efficiency ratios, we'll not look at it immediately. Or okay, we can just understand what is efficiency ratio. So do we have inventory turnover over here? We'll not look at days, we'll look at inventory turnover ratio. So let's look at it this way. Let's say that every year I have an inventory. Let's say I have let's say I have an average inventory of 100 crore. Okay. And my sale is also 100 crore. This is case one. Case one. Now let's take case two. 1,000. My sale is 1,000 crore, but my inventory is just 100 crore. So what does this mean? This means that this company two, let's say company two, and this is company one. So inventory is basically stored in the warehouse. So if a company has, say, it's manufacturing some slippers or some refrigerator or some TV, it is basically stored in the warehouse, stored in the location, and it is yet to be sold. So in this case, the company has actually 100 crore worth of inventory, but the sale is also just 100 crore, right? So it means that this inventory is a very high number. The company's capital, all the company's money, etc., is stored in the form of those unsold items. Let's just take the example of TV, right? The unsold TVs are basically worth 100 crore, and on average, a TV that gets manufactured will take 1 year to get sold, right? It is in the inventory for 1 year because these two numbers are same. In this case, the company is actually selling 1,000 crores worth of items and only 100 crores in inventory. So the amount of money that is stuck in these goods that are produced but not sold is quite low, which is actually a good sign, right? And let us say this company too also produces a TV. So this TV will take, say, 12 by 10, right? Approximately a little over a month for one TV to get sold. It is in the inventory for about a little over a month. So inventory turnover is nothing but the cost of goods sold. We'll just say cost of goods sold. We don't take sales, actually cost of goods sold by the amount of inventory. And here this ratio is 1 and here this ratio is 10. So this is just something we need to know. We don't have that over here. We typically don't have that on screener. Let me see if we are able to generate it. Yeah, inventory turnover ratio is greater than 10. Let's say how many companies come, not many will come. 543 is companies. So let's say this is more than 50. There are 100 companies. Okay, but this is what inventory turnover ratio tells us, that companies which are, you can see over here, there are okay, there are a lot of very profitable, there are a lot of companies whose profit is growing quite fast. Let's see, let's go down and see. There is nothing here. Let's go to the second page in terms of profitability. So you can see typically when a company has a good inventory turnover ratio, they seem to have a good amount of sales growth. And let's look at profit growth. A lot of them are also growing profitably. So we can see we have 86 companies where we were able to see the 3-year profit growth, and out of them about 70 companies were growing in terms of the profits year on year, right? So typically when the inventory turnover ratio is high, that's a good sign. So now we'll go to the next set of ratios. I don't think we have valuations here, right? Okay, so we'll not come to these. Efficiency, leverage, market ratio, liquidity, leverage, and then market ratios. So next thing that we'll go to is the market ratios. These are the main things that we look at. The first ratio that we have to look at for any company is the price to earnings ratio, right? Let's look at a 10-year chart and let's look at the PE ratio. So what is the price to earnings? Let's say that a company, let's just say that, let's take the case of Asian Paints. Okay, we will look at what is the earnings per share. Okay, price per share. So let's say Asian Paints has a price per share. We'll not take the actual value. We'll take a hypothetical value of 5,000. The earnings per share is 100, right? So in order to buy a company which has an earnings of 100, you are actually paying a price of 5,000. So what is this price per earnings? This is nothing but this by this. Okay, so this is one of the most important ratios that exist, and we should understand this very, very clearly. Now, now there is another way to look at it. market capitalization. There is something called market capitalization. Market capitalization is nothing but total number of shares into price per share. Okay, this is market capitalization. And then total earnings. So this is also, so market capitalization by total earnings is the same as price per share by earnings per share, because price per share is market capitalization divided by total number of shares, that is price per share. Earnings per share is total earnings divided by total number of shares, which is earnings per share. So this is also the price per to earnings ratio. Now, typically, how do we use the price to earnings ratio? In an average case scenario, we'll talk about an average case scenario. So in an average case scenario, there is this number. You see this little dotted line over here. This dotted line gives the mean of the price to earnings, right? When a good company, so we look at companies which are profitable year on year. So we can see over here, Asian Paints is profitable year on year, and it's made a huge amount of profit every year, right? More than 1,000 crores, even 10 years back. So when a company is profitable year on year, we will look at those periods when the price to earnings is lower than the mean, much lower than the mean. Okay. That is typically a good time to buy a stock. And then when the price to earnings goes much higher than the mean, that is typically a good time to sell the stock. Okay, so let's look at this. Around December 16, P was around 41. Okay, and now let's look at this period here. Jan 22, P was 105. So from this December 2016 until Jan 22, the share would have given a very good return. So let's see. We go here, and then you see here, this is around December 16, it was 899. And then this is Jan 22, and then it is 3,500, right? So over a period of about 5.5, 6 years, whatever, this share went up from some 900 to some 3,600, which is 4 times. And today the share price, this share price, which is 3,500, today has gone down to 2,200. So one of the key rules is buy. So look at a company. So let's look at it this way. Look at a good, profitable company. Okay. Year on year, it should be profitable year on year for at least 5 years. Profitable year on year with growing profits. To be safe, actually, we can make this 10 years. We can't go wrong there. Okay. Look at a good profitable company with profits for at least, with a growing profits year on year for at least 10 years. Look at those periods when the PE is much lower than average. Okay. And it's usually a good time to buy. We have to analyze all the other factors. We should see that there is no debt. We should see the, all the other numbers we'll talk about. We have to see all those ratios. But usually, on average, it's a good time to buy. Okay. When the PE is much higher than the last 10-year average, usually a good time to sell. Okay, we can even do this for 5 years. So there is no hard and fast rule. I'm just giving a thought process. So let's say for at least, let's just make it 5 or 10 years. Right, that is typically the time it takes for a good full cycle to happen. 10 years is usually better. Longer time periods are better. But this is one of the key things we have to see. So now let's take another company. Okay, Titan. Okay, so now for the last 10 years, company has 700 crore and it's gone up to some 3,200 crore. So the profitability of this company has gone up significantly over the last 10 years. Now let's look at the PE ratio. We can see PE ratio was very low here. It's gone very high here, and then it's come down here, and then it's going up. Okay, we'll talk about this. There was when earnings sometimes get depressed, then PE can go down. Okay, let's look at something like this. Okay, so PE ratio was some 35 here, and then it went to, okay, this was during COVID. During COVID, the profitability went down. The company's profitability went down, so the PE went abnormally high. But on average, let's take this period. Let's not consider COVID. This was an exception. Let's take this period from July 15 to about April 18. How did the company's share price go? And then from April 18 till about, let's say, April 20, how did the share price go? From here to here, it would have gone up a lot. And then here to here, it would have typically not changed by much. That is my guess. So now let's look at the price. Okay. So here it is 973, and then we were looking at some July. So here it was some 400 to some 980 something. And then from here, from 980, it again went to some 1300 or something, but it came down to 936. So we say whenever the PE ratio is depressed, then it's a good time to buy for any good stable stock, any good stable large cap. Whenever the PE is depressed, it's a good time to buy. Whenever the PE goes up, it's a good time to sell. And again, the rule is the company should be good profitable company year on year, 5 to 10 years with growing profits. Okay, let's use this for well-known brands only. Use this for well-known brands. You know the product, you've seen the product, you know it's genuine. It's usually a mid to large cap company, and then we can buy it. So let's take another example. So this is Procter and Gamble. I think it's health and hygiene that we should buy. Yeah, we are not looking at we are looking at the FMCG company, not this. Okay, so you can see here the company's price has been steadily going up and then it's kind of come down, right? So somewhere here PE ratio must have been at a peak and then the PE ratio must be coming down over here. That is my guess. Here PE ratio must have been on the lower side. By here PE ratio must have gone quite high. That is my guess. Let's see. And you can see here PE ratio here is on the lower side. It's gone very high over here. It's again gone a little bit low. It's again gone high. It's again gone a little low. So typically when we find good companies, you can make a list of all the good companies, you know, usual FMCG typical companies, and see, okay, when is this PE ratio very low? And then as it goes very high, you sell it. So we may not be able to find this exact point to sell. We may not know what is that exact point where the PE will go, but when we see that the PE ratio is much higher than the average, then we know that, okay, it's a good, and you are at a good profit, just sell it and make that money, right? So PE ratio is a very, very important number. But now we'll talk about one more important aspect of PE ratio. So we can see VIP Industries over here, right? Let's look at this. So we are now looking at the PE ratio of VIP Industries. Now, as you can see here, the PE is 23. This PE is coming here, coming here, coming here. And then you can see here, once COVID started, this PE went very high. It went to some 180. And then there is nothing. There is no PE ratio here at all. And then suddenly this PE ratio reappears. Why? Because during this period, VIP Industries was typically making losses. Okay. So during this period, we see over here, during March 2021 and all, VIP was making losses. Because the company was making losses, so price per share, let us say is 5,000, but earnings per share, let's say is minus 100, right? So this PE ratio becomes actually a negative number. So they have not shown it over here. They have just said this does not exist because what is the price you are paying for the stock? That is what this means. Like, let's say you are buying a shop, you're buying a grocery shop. That grocery shop is making 10 lakh profit per year. Okay. And that owner has said, you pay me 50 lakhs, right? Then what is the PE ratio? It is 50 by, this is 50 by 10. That is basically a P price to earnings of 5. So you are saying that for 5 years, if once I own this shop, assuming that the earnings is 10 lakh per year, it will take me 5 years to recover my money. And then after that, I will start making a profit. Right. So let us say that the shop is making a loss. That shop is making a loss of 10 lakhs a year, right? So in that case, if the owner says the shop is making a loss of 10 lakhs per year, you please give me 50 lakhs. As a buyer, you may not even consider buying that shop. You're going to lose money on that shop. So typically when the price to earnings becomes negative, they don't show it. So that's why they have not shown anything here. Right. Now let's take some IT companies, well-known IT companies. Okay, we'll close it with that after this. You see over here, Infosys has gone up, come down. Okay. And you can see the PE ratio as well. Here the PE ratio was some 14, 15, and then it went all the way to some 37, 38. And as the PE ratio was very low, the price was also very low. And then once it went up, this price went up significantly. Like so from whatever number. So let's say this was some 480, 490, whatever, and then it has gone up to some 1900. Now we have taken Infosys, we have seen TCS. Let's just see Wipro. Okay, so we see here that this P ratio here is low. It's gone high. It's again gone low. This has again gone high. But again, we don't know if the earnings were deflated because of COVID. No, the earnings were not deflated because the earnings per share is going up. So during this period, Wipro would have gone quite high. Wipro would have again gone down. And then it is again starting to go up. That is my guess. Let's see. So you can see while the PE ratio was low to high, it went up, then it again came down, then it again went up, then it again came down, then it again went up. So in this way, we can see, okay, what are the companies, what is a good point? So we can actually find out what is a good point to buy a stock and what is a good point to sell a stock. So how do we look at it? Let's say PE, historical PE, price to earnings is less than the historical PE of the last 10 years, right? This is what we are looking at. This PE should be less than the average PE of the last 10 years. And now we have some 1,000 companies. Now let's put in another and. We have already read that return on equity should be good. And return on capital employed should also be good. And return on capital for the last. Okay. Okay, so this is not giving 10 years. Fine, we'll just use 5 years then. We'll also use 5 years here to keep it uniform. Okay. And we know that debt should be low. Okay. Debt to equity is less than 0.5. Okay, let's run this. Unknown 15. Okay, we should put an and here. Let's run this. So now instead of 1,000 companies, you have 100 companies, right? Now in these 100 companies, we will start looking at, we can even reduce this even further. So let us say, okay, so this means it has to be at least 25% below the historical P. Then let's see. Now we only have 27 results, right? So now we can start looking at these results and then seeing which are these companies where I want to invest. So let's take a simple example. We saw Berger Paints earlier. So we look at Berger Paints here, you can see, oh, this price is like very, very down. You look at the last 10 years, you see this price is very, very down. Maybe let's see this from here to here, from November 16 till about Jan 21. This must have given a pretty good result. You see here, November 16, it gave 178 to about 700. So now it is again down. So there is a good chance. We don't know this. This may last another 1 year. It may last another 1.5 years. We don't know. But now the number looks very interesting. From here, if I hold it for the next 5 years, I may make a good return. Okay. So we've started now indirectly talking about how to use these ratios and start making money. There's a lot more to be discussed. So next class, we'll continue. So any questions on what we discussed so far?
Harish?
Yeah.
So when you're talking about earnings, so what does earnings comprise of? Like, is it the earning to the shareholder or is it like the company's earnings like net profit?
See, this is the net profit. Okay. This is the net profit over here. All right. Below this net profit, you see there is something called earnings per share. Now this net profit.
Okay.
So last year, for example, in 2024, Berger Paints made 1,170 crore of profit. When they divided it by the total number of shares, the profit per share was 10.02. So we are talking precisely about this number.
Okay, got it.
Right. So I had said two things. One is price per share by earning per share. So you as a shareholder, you are looking at this price per share, that is this one, by the earnings per share, that is this number, this by this, right? Or the same thing is also equivalent to the market cap, that is 51,565 crore by 1,170 crore. Both are one and the same. Taken for a previous year. So given on that particular date, let's say on March 31, it was such and such an amount, and then we compare both of them on the same time, that will give us the same price to earning ratio.
Okay, got it. And just one more doubt, like you said, for return on equity, more than 15% would be a good number. So similarly
That's
for
a thumb
return on
rule.
asset,
There is no hard and fast. Like for a person who is new to investing, we just have to be safe. Like better safe than sorry. The first rule of investing is not to lose money, right? And the second rule of investing is not to forget the first rule. Yeah.
So similarly, is 15%, I mean 15 a good number for ROCE too?
As a starting point, we can take 15. If you want to be really safe, you can take 20. But as you start understanding companies more and more, then you will come to situations where you say, okay, yeah, this ROCE is 10, but I know this company is fine. Or this is just a temporary phase. This is the good time to buy it. So you'll come across all such situations once you get experienced. But given that we may be new, it is better to be safe. So that is why if you want to be really safe, go for 20. If you don't find enough opportunities with 20, then maybe you can go up to 15, but don't go below 15 right now, at least.
Okay, thank you.